Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He tells us, according to Dow theory, that index has a 90% sell signal in place. Ross takes a close look at gold, silver, crude, and the U.S. and Canadian dollars, along with cocoa. Publisher of the Real Estate Timing Letter, Robert Campbell, checks in from San Diego. He says after going over 100 years of data, he has never seen such a constrained housing supply in the U.S. Bob also believes gold and silver are a great way to secure your long-term financial security. The editor of WolfStreet.com, Wolf Richter, says Chrysler products like Rams and Jeeps are overflowing car dealership storage yards, and some deals could be had. Ford also has an oversupply of vehicles. Wolf also tells us that U.S. consumers, despite some grumblings, are still surprisingly in good shape. We'll talk to Ross Clark right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Always good to be back, Jim.
Ross, how would you describe the stock markets this past week?
Well, let's see. I guess it was catch-up time for some of the markets that had been going just a little too smoothly on the upside, and they rolled over. Others that really hadn't been doing too much had a little bit of a breather, but have held in there pretty darn well. The big thing a week ago was the NVIDIA announcement on the earnings. I guess that was a week ago, Thursday, and the NASDAQ rallied well on that, but it was mostly just on NVIDIA. And if you look at the other indices, they really didn't participate too much in the tail end of the rally, and especially if you look at things like the equal weighted indices. The S&P equal weighted index, the RSP, which is the ETF for that one, it topped out back in the last week of March, put in a marginally lower high 10 days ago, and then eroded away again into the middle of this week. Whereas, the S&P capitalization weighted, which has got a lot of those high-tech names in it, managed to put in a new high for the run, but not a lot of follow-through. And on the Dow, that really was the weak sister all around. We had the Dow put in a marginally higher high in 10 days ago, but just got hit all the way back down towards the April lows here as of Thursday. And the interesting thing within the Dow then brings up the thought of the Dow theory, where you go back in history when the transports and the industrials fail to confirm each other on new highs and then go and take out supports. That becomes a Dow theory sell signal. And it's not so much short-term timing, but it determines that the major trend has turned to bearish rather than bullish. And right now we've got the first parts of that equation in place. There's divergence on the highs, which is important. Both of the indices, the transports and the industrials, managed to go down and basically kiss those April lows this week. They bounced at the end of the week, but if there's an erosion down through those support areas of April, that would suggest that the overall transition from a rounding top into maybe something of a much deeper correction is just around the corner.
What's going on with gold?
Gold, we ended up with a week that had been oversold a week ago, but the bounce was pretty mediocre. We got down to 23.25 on the correction and got a short-term oversold reading, but only recovered about a third of the drop from the all-time high, and we're back down at the supporting lows again. Silver had a better recovery, recovered about 90% of its pullback, but then again, it's right back down towards the support area. We've got to be careful here in terms of the seasonality. We tend to have June being a poor month for precious metals. You typically would be looking for a July low. So we've got to be careful here to see that these things don't take out some support areas. The commitment of traders numbers have both the commercials and the specs at positions in both gold and silver that suggest that the speculators are definitely overweight on the bullish side of the equation, and the commercials have got nice large short positions. They tend not to be wrong at the top, so a correction at this point wouldn't be at all of a surprise. I really need to see the silver market hold in around $29 to hold its upside bias up. Otherwise, we could be looking at a deeper correction.
What's going on with crude?
Crude, we've got the OPEC meeting this weekend, and it had a decent bounce during the week, got up and tested the 50-day moving average at $80, couldn't hold that, so we've now had, 3 attempts here at $80 during the month of May, and we're right back down at 77.25 at the end of the week. If you take a look at the count here, first break was from 88 down to 81, a bounce to 84, the next break to 77 and change, and then this bounce to 80. So from just a technical perspective, it would suggest that if we take out that support, we're probably looking at something in the mid to low 70s before this correction has run its course on the downside.
Does that mean a summer of affordable gasoline, a summer of holidays with your family in the woods?
Well, yeah, possibly. All they got to do is take away one of those taxes and make it even more attractive.
Good luck there.
But the key is, if you're going to be out on the road, keep this. Don't throw the cigarettes out your window, and if you've got a campfire, make sure that you got it out by the time you walk away.
What's going on with the U.S. and Canadian dollars?
Both currencies still inside their trading ranges. The U.S. dollar had a week. We closed at 104.5. We've sort of been bounded by, as I say, this broad trading range. There's nothing really to speak of here in terms of the U.S. dollar index. Canadian dollar, the same type of thing. What we have to watch for is that the Canadian economic numbers that came out this week show that things are slowing down. The probability now of the Bank of Canada dropping rates either next week or during June, get my months straight, or during July are pretty darn good at this point. And the differential on the interest rates, we're now on a 5-year basis. If you look at the 5-year notes, it's about 0.83 is the premium of Canadian rates over U.S. And if they do drop rates by a quarter point or so, which is what the street is looking for, that could be enough to just take the support area out of the Canadian dollar.
Anything happening with cocoa and uranium?
Well, the cocoa had that big run just like we saw in OJ, and in the case of OJ, it had a good correction and has gone back to new highs. Cocoa had, that exponential run that went on for ages, had ended up with a good solid correction. It's now got a double bottom support area, so maybe this one's going to do what OJ did and make another run for the highs again.
Ross, thank you so much for the update.
Pleasure to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Check him out on X at Charts by Ross. Coming up, Robert Campbell, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Robert Campbell, publisher of the Campbell Real Estate Timing Letter. His website, realestatetiming.com. He's speaking to us from San Diego. Welcome back to This Week in Money.
Thank you very much, Jim.
Bob, when does the next issue of the Campbell Real Estate Timing Letter going to be published?
It's published once every 2 months, 6 times a year, and the last issue that was published was the May 15th, so it was just published 2 weeks ago, and the next issue will be published in July 15th.
How can people sign up for it?
They can go to my website, realestatetiming.com, just like it sounds, realestatetiming.com. And interestingly, I've been publishing that letter for 23 years now, and interestingly, about 20% of the people, I would estimate, that subscribe to my timing letter aren't even real estate investors. They just like the way I think, the way I analyze data and use it differently than other people, and it just makes them think about things differently, even though people are still interested in real estate. Most people own a home and that kind of thing, but it's not your hardcore real estate investor that's, looking to sell high and buy low.
How's your book, Timing the Real Estate Market, doing?
It's doing fine. It was published in 2002, 23 years ago. I still use the exact same formula today that I developed then. It was very well researched. And I'm in the process of starting my second book. Oh, my God, I know. I'm submitting myself to this torture. That's the torturous thing I ever did was write a book. But I'm going to do it because in the last 23 years, I've at least tripled my level of knowledge about real estate timing, and I have to share that knowledge with the world before the angels take me away.
Gold has broken out to new highs. What are your thoughts on that precious metal?
It has broken out to new highs, and we are in the beginning stages of a multi-year bull market. And it's going to go to levels that are just going to astonish people. One, for the primary reason that there's no fever like gold fever. And once gold picks up and starts gaining momentum, it's just going to go to levels that are just going to blow most people's minds. So it's I've been a investor in physical gold for a long time. I don't try to time the real estate market. The gold market, like I do real estate and other markets. I just tend to accumulate it over time. That's my safety hedge. That's where I get my liquidity. I can take a 1 ounce gold eagle or a 1 ounce maple leaf, take it to a coin store, and turn it into cash within hours. And you can't do that with real estate. And it's not as volatile as gold, the stock market. And so that's my liquidity, and I consider that to be the ballast in my boat. And it's served me well over time. Interestingly, most people think that gold is always a pure inflation hedge, what isn't true. But over time, over a long period of time, gold has proven itself to be a very, very good inflation hedge in so much that it has protected the purchasing power of your dollar. And when gold makes bull moves, like it did from I think it was 2000 to 2011, and it's doing now from 2023 to whenever this thing's going to be over. I mean, you just make these huge, huge profits in gold. But I'm not the kind of guy, I don't buy low and sell high in gold. I buy gold and hold it forever, and it's, I have instructions in my will that I'm to be buried with it. I'm just kidding.
So you can take it with you.
Yeah, you can. If you want to take your gold with you, you can take it with you.
You and the Egyptian pharaohs.
Yeah, exactly. But there's something about gold. I've been attracted to gold my entire life, even when I was a kid. I mean, are there better long-term investments than gold? Yes, the stock market. The stock market's a way, way better. If you want to invest long-term in any asset, the U.S. stock market is the best place to be. And knowing what I know now, what I would do if I was starting out as a kid, whatever money I invested that I was going to allocate to the stock market, I would do what's known as dollar cost averaging. Let's say you're going to save 10% of what you make come hell or high water, and let's say you're going to invest half of that in the stock market. Every month, I would buy the stock market, whatever the price is, higher, low, higher, low, higher, low. And then after, 30 or 40 years or whatever your time frame you're shooting for, you will make the long-term averages of the stock market, which is about 10% a year. And the stock market, performs, approximately 5% better than inflation. That's the thing to do. The problem with is most people aren't disciplined like that. They're not disciplined to do that. All of a sudden they lose their job, or times get bad, or, all of a sudden they want to, buy a new car as opposed to investing every single month in the stock market. But looking back, that's the ideal way to invest. Don't even think about the price. Just put money in, whatever you're going to allocate to the stock market every month, month after month, year after year. Then when you get to be 65 years old and cash in, you'll have more money than you know what to do with.
Silver, is it going to outperform gold?
Well, actually, gold, it depends on your time frame. I mean, is silver outperforming gold right now? Yes. Going back 5 years, has silver outperformed gold? Absolutely not. Absolutely not. And with respect to my own investment in precious metals, I own physical silver and I own physical gold. I own at least 10 times as much gold as I do physical silver. Silver is way more speculative, way more volatile, but is it going to go up too? Yeah, it's going to go up. But gold, over the course of time will outperform silver.
The Dow hit 40,000 points as inflation continues. Is the Dow likely to see more new highs?
It could, but I doubt it. I think we're in the process, and that's a really interesting question, because I think right now we have reached the limits of this current economic asset boom. We're really, really close to the end, Jim. And, the stock market can do whatever it wants to do. And interestingly about the stock market, like I said, it's a very, very good inflation hedge. But right now, what's really hurting the stock market and business, and we're just starting to see the beginning, the start of of the problems, inflation is really hurting. And I know the government's reports, which you can't believe, they say, inflation's at 3%, which is total BS. That based on what I see and what I hear from people out in the real world, it's at least 8 and probably 10, so it's probably somewhere in that range, 8 to 10%. And what's happening right now is the average American consumer is getting decimated by inflation. Unless you're in the top 10%, you're getting hurt real badly. Like, for example, like homeowners insurance is going up dramatically. Car insurance is going up dramatically. Food prices are going up dramatically. Rent prices are going up dramatically. All these essentials that people need are going up, and up, and the average guy, the average American, is getting nailed by it right now. And so the consumption is down. Consumption, it hasn't fallen a lot, but it's going to fall. And they say, oh yeah, but we're still growing here in the U.S. at 1.6% per year or whatever the thing is. That's total BS too, because whatever the number is that they're using, that GDP number is adjusted for inflation. What inflation number are they using? The government's number. Yeah, if they were to use the real world number, let's call it, let's just say, it's 10%. We would have been in a downturn for for probably the past 12 months. So I think I'm always hesitant to call, major terms in the economy like this, but I know what inflation is doing to the purchasing power of the average American, and it's hurting them badly. And what it's going to do, it's going to cut discretionary spending. And when discretionary spending gets cut back, that's going to be hard times for a lot of people.
There's a lot of anticipation for the Fed to lower the bank rate. Your thoughts on interest rates going forward?
That's a million-dollar question too. I think because that regardless of what they were made to do, it's a political organization, and it wouldn't surprise me that if the prior to the election in November of this year, that the Fed drops interest rates come hell or high water, strictly for political reasons, trying to get the incumbent president reelected. I mean, will that be good? No, that'll be terrible. It'll fuel inflation even more. But it'll be totally a political move, and it wouldn't surprise me if they do that. But one of the things, and we're talking about recession now, what most people don't understand is the fact that big government is what's driving the train right now. Big government in the United States is spending, approximately $3 trillion a year more than it brings in tax revenues. That's almost 50% more than they make, they're spending. And it's going on top of the national debt. Even though they say the deficit this year is only going to be 1.7 trillion, that's not true. Because last year they said the same thing, and the national debt went up $3 trillion. And the only reason the government, borrows money is to spend it on something. And spend it on something that money's not being brought in from tax revenues. So we're essentially running a $3 trillion a year deficit. And that's really hard to go into an economic downturn when the government's overspending like that, and they can spend as much as they want. Because all this overspending creates new jobs, new opportunities for the people getting the money, and that's why things are so inflationary. They're spending money they don't have. A lot of money they don't have.
Is the housing market showing signs of cracks in the foundation?
Finally, which is my area of expertise, that the U.S., I made a call on the housing market here in the United States that the peak of the market was in May, June 2022. May, June 2022. Since that time, housing prices nationally, then it took a downturn. And I said, okay, this is it. Then it took a downturn. Then it's headed back up again. And in most areas, it's gone up to new highs. But interestingly, relative to that May, June 2022 peak, housing prices in the United States as a nation as a whole are higher by 2%. And relative to, when you factor in the risk after this huge cycle we've been in, where housing went to new highs, and the bubble this time is even bigger than the last bubble, and that housing affordability is even worse this time than last time, and that's a key indicator that most people don't focus on, which is one of my key indicators. Housing affordability has never been worse. And it has been worse. In California, every time in the past 50 years, every time housing affordability has gotten at 17% or below, we've had a major correction. Now, you say California, I know that's the most volatile real estate market in the country, also the most profitable real estate market in the country. Every time it's hit 70% or below, we've had a major correction. And there's been, I think, 5 corrections. It's 5 for 5. There's been no exceptions. Well, right now we're at 15%. And so I expect a huge correction in that, along with nationally. I mean, all you got to do is look at the charts. Look at the charts and see, okay, when this happens, what happens? When this happens, what happens? I know they say history never repeats exactly, which is true, but that some things just can't be denied. And real estate is very cyclical. And when affordability gets to these levels, I mean, it's just logical. People can't afford a house. So what happens? Something happens at that point in time that causes real estate values to go down, and I expect a significant correction, somewhere in the range of, anywhere between 30 and 50%, a downturn in housing prices, depending on the location. California will probably fall 50%, and that's the time you want to step in and buy. And that's the time you have to be patient, you have to be smart, and those times are worth waiting for.
What's the latest on housing inventory and days on the market?
Yeah, that's the new game, guys. And it's not so much days on the market, and this is really, really key and hardly anybody talks about it. It's number of months of supply on the market. That I've done some analysis of this, and I've looked at other people who have done some analysis of this. And anytime the number of months of supply on the market is 6 months or below, housing prices go up like 95% of the time. And when they're above 6 months, they go down 95% of the time. And where are we right now? On a national level, we're at, I believe, 3.5 months. Okay, that's still below 6 months. So that means that's the only thing that's supporting housing prices. Because all my other key fundamental indicators are showing weakness, which are, new home building permits, existing home sales, mortgage defaults, foreclosure sales, mortgage rates, all showing that. So it's still below that. But what's important is that in the last 6 months, 7 months, that number wasn't 3.5%. It was something like 2.7%. 2.7 months. So the trend is definitely up. And you could tell it's up not because the number's bigger, but the number of months of homes on the market is making higher highs and lower lows in the last 7 months, which is one of the acid tests of whether we have a trend or not. So I expect this thing to continue. And I think that, once that gets over 6 or close to 6, then you're going to see significant weakness in the housing market, and prices are going to come down substantially. And guys, this is all based on data. None of this is my personal opinion. None of this. I just know what data to look at that has historically been a reliable leading indicator to price movements in housing market. I take all my own ego out of this completely. And that has served me so well over the years. I know, I don't look at, month-to-month data like most people do. I know it gains headlines and things like that. I don't do it. I've been doing this so long, 24 years, I know exactly what to look at. When I first started out publishing a newsletter, I probably had to work 5 or 6 hours a day to publish a good newsletter every 2 months. Now I only have to work an hour a day because I know what to look for. I know what's important to focus on and what's not important. So I don't focus on the non-important things. Do I learn new things, occasionally? Absolutely. I know what to look at. And I look at these things and I go, that's why housing prices are still, keeping their head above water. Is it worth the risk to buy into this market? 100% the answer is no. It's not. It's super high risk. Super high risk. Just wait. Just wait. And I could show you patterns and go back 50 years. Up, down, up, down, up, down. You see the pattern? Yeah. You think this pattern is going to be any different on the 6th time, after the 6th time up? No. Yeah. Could it be different? Yeah. Like about 10%. You don't want to take, bet on something where there's only a 10% chance of success. And even then, we're in the final stages of this boom. I don't care if housing prices go up another 10% from here for whatever reason. It doesn't matter. Risk is high. I put you in back in 2012, and I had you in this market for 11 straight years. You made huge profits. What, do you think you're going to get out exactly at the top? Dream on. It's not going to happen. Now's the time for the correction. Now's the time to wait for the next buying opportunity. And, I'm doing that as well.
In a real estate downturn, do sellers want to get yesterday's selling price resulting in their property not selling?
Absolutely. And, and that's true. My background is real estate development, and I've seen, home builders do the same thing. But that home builders, it's more prevalent with private party sellers. And the favorite, I've been around real estate my entire life. And home sellers say, well, I'm not going to give this property away. 5 years, last year it was selling for, $900,000. And what? You tell me you want to list it today at $800,000? No way. I'll give them something. I'll list it at $875,000, and the friggin' thing doesn't sell. So all of a sudden, now the market price is not $800,000, it's $775,000. And they'll go, hey, I'll drop another $25,000, but I'm not going to give this thing away. And a lot of people ride the market all the way down. In my experience, it's the smart guy that knows the cycles, know what's going to happen, know what's likely going to happen in the future, and they say the market's down. One really sophisticated guy I know, that he said, when the market turned down in 2006, he had a couple condos to sell here in San Diego, and the market value at the time was whatever it was. Let's just call it $500,000. He put them on the market at $475,000 and sold them both. Where did the market go in the next 12 years? In the next 12 years, 6 years before it hit bottom, they went down to $250,000. He got ahead of it because he's smart. He had a big profit. He wasn't going to lose it because he was greedy or stupid.
In Canada, the housing market peaked in early 2022. How far into a housing collapse are we likely to see a waterfall drop?
Well, waterfall drops the waterfall drops tend to occur, at the start of a collapse. And I've seen some charts where you guys have turned down relative to the mid-2022 high. Waterfall declines typically happen early. They just go right over and that's what catches people by surprise. But so I don't know if it's waterfall, but it looks like you guys are in a significant correction too.
Do housing markets crash from the top down?
Actually, price. Actually, what happens in housing markets here in the United States is interesting. Everybody thinks that, it seems to believe that, or it's commonly believed that the high-end market is the first to break, and that's not true. It's the low-end market that's the first to break, because that's where the weak-hand money is. Everybody buys like a inexpensive rental property, and then the market starts to turn south. Those are the prices that are first to get hit. And then the high-end market is the last to go, and that's at the peak. And at housing market bottoms, it's not the high-end market that takes off first; it's the low end. So if you're good at timing markets, and I'm not afraid to say that I am way, way, way better than most, you want to buy low-end properties, because they will fall more than high-end properties, and they will go during the downturn, and they'll rise more than high-end properties during the upturn. So buy a bunch of low-end condos. I don't care what you buy. Low-end rentals, because those are going to outperform, a high-end property every time.
If the housing market crashes, wages and material costs are unlikely to follow. Could that mark the end of new home construction for a considerable time?
Yeah, it could. It could, and it depends on the material costs for products to build a home are still just out of sight. How expensive it is. That I'm remodeling my home right now, and there's this type of the best primer on the market. 3 years ago, that stuff was selling. That primer was selling for $50 a gallon, which was 100% more than the average water-based primers. It was selling for $25 a gallon at Home Depot. But I buy the best because I want something that's going to last long term. I was just in Home Depot yesterday, and I looked at what that same primer was costing, $72. In other words, in the last 3 years, that material cost has gone up 40%. And you know what? And I hear stories like plywood prices. The only thing that's come way down is 2x4s, 8-foot construction grade 2x4. Prior to the pandemic in 2020, at Home Depot they were selling for $3 each. Then they went up to $8 each when the shortages developed. Now they're back to $3. But in general, have material costs come screaming back down to where they were 4 years ago? No. They're still highly elevated, which makes building costs really, really high. And so that's all factored into the price of a new home. And so not only will demand fall, but it's going to fall not only because of people don't want to buy a house in a falling market, it's going to fall because of high prices that until those material costs, come down, or if the fact just the demand for new homes in general, disintegrates to the point where it doesn't matter what the thing costs to build. People don't want them, and that'll bring the price down. But new home prices are going to come down like everything else.
Is it getting tougher and more expensive to get mortgages?
I don't think so. I think it's still relatively easy because and it's been that way for the last year or two. When polls are made, they said, is it easier or harder to get a loan today than it was a year ago? Interestingly, most people say it's easier. It's easier. And that doesn't surprise me either because of the government, big government in control of everything nowadays. They don't want to let this thing fall apart, not only for the state of the economy, but probably more importantly for what's more important for their pockets is who wins in the next election. They want to keep this thing propped up, so they have their fingers on everything. The old idea that a democracy is a free market economy, that's an ancient myth because the government, big government has their hands in everything nowadays.
What are your leading indicators for home prices showing?
Well, what they're showing is that there's 5 leading indicators that I present in my book, Timing the Real Estate Market. Number 1 is existing home sales. Existing home sales are significantly down from the peak back in mid-2022. I would say they're down, 20-30%. Very, very negative sign. New home building permits. New home building permits have held up a little better, but they're still down 10 to 20% from the peak in mid-2022. And because the supply has been so low, housing prices have more or less held their own, in most places, that foreclosures and notice of defaults are flat to mildly up. It's almost impossible to get into a bad situation with the low supply today as a seller. If you lose your job, whatever reason you get divorced, will your house go into foreclosure? No. I mean, will it go 90, 120 days before the bank files a foreclosure notice on you? No. Why? Because you'll put it on the market, well prior to that, and it's almost guaranteed to sell at a reasonably high price. So those things are going to come later. They're going to come later. Once the demand keeps falling. So here's what's happening. Demand is still falling. Demand is falling for homes, okay, and in the big picture of things, when demand is falling, the price of housing falls. Here's the exception that we've never seen in the last 50 years. We've never seen supply so constrained. And so, in other words, if you have 100 homes selling at a certain price, let's say $100,000 a piece, and demand for those 100 homes falls by 30%, normally the houses wouldn't sell for $100,000. They'd sell for less. But if supply drops by an equal amount, by 30%, you still have the same supply and demand dynamics. And you can take it even worse. You can even take it down to, okay, let's say there's only, 50 home sellers as opposed to the old 100. Okay, what if supply drops by 50%? You still have the same supply and demand dynamics that, will keep housing prices from falling. So those dynamics are in the process of change right now, and until they do change, and that could take some time. I don't anticipate that happening very fast. That could take 6 months. That could take even longer. That housing prices are still going to remain buoyant.
What are your thoughts on the argument that home prices always go up over time, so it doesn't matter when you buy?
Well, that's, of course, and I'm glad you brought that up, because that is a function of what is your time frame? What is your time frame? Okay, the going up, like let's say here in where I live in San Diego. When I graduated from UCLA, I could have got a job for $12,000 a month and bought a home in the town I grew up in, Encinitas, less than a mile from the beach, and bought a home for like $65,000. Okay, what's that home worth today? Now we're talking like 69, we're talking 70, we're talking 55 years later. That home's worth $2 million. So you can't deny over the long term home prices go up. But in between those two times, there have been 4 booms and 4 busts. So when you look at things, and the average period of time that somebody owns a home, I've read 7 years, I've read 10 years. 7, so I don't know what the actual number is. There's no way to confirm that. But it's somewhere, you say, most people don't own their home for 55 years. What percent of all homeowners do you think buy a home and own it for 55 straight years, especially in California? I would say, 5%, maybe? I'm just, speculating on that. So in other words, most people buy and sell for a variety of reasons. For, job move, they lost their job, death, divorce, whatever. So right now I'm in the process of doing a study, and you go back to those days, go back to 1969, and you say, okay, let's look at over 7-year periods and how it performed, how housing prices performed, and how you did. So in other words, what happens is that when you buy, the price you pay when you buy makes a significant difference in the returns that you're going to receive over the next 7 years before you have to sell that home. Significant. And so timing does matter. It does matter. And it was really astonishing for me to see the results. For example, if you'd have bought a home at the peak of the market here in California in 2006, that's when my timing model told you to get out of the market. Okay, it took you 14 years to get back to break even, guys. 14 years. People don't live in a house for 14 years. You could be underwater on that home for 15 years, for 14 years. So when you buy and when you sell makes a significant difference to how you're going to do in real estate.
Let's use California as an example. Right now, you have mortgage rates that have increased significantly and home prices that have not dropped significantly. Could there be a worse time to buy a home?
It's hard to imagine. Like for the state of California, I think housing prices are up maybe like 1 or 2% above their mid 2022 highs. There are exceptions, however. San Francisco, home prices are down almost 13% since then. San Diego, on the other hand, home prices are up like 10%. So there are big differences. But in the big scheme of things, the big picture, super high risk, guys. Super high risk. You can't get away from it. You can't get away from it. That's like playing Russian roulette, and somebody offers you $1 million to say, okay, will you play Russian roulette for $1 million? And they go, no. And all of a sudden they spin the chamber and fire, and nothing happens. And people go, you see, I could have made $1 million. Yeah, but the risk of losing everything is huge. So you got to pay attention to the risk, guys. And where are we? Risk can be measured. And typically it's measured by certain metrics over time when housing prices tend to go from up to down and down to up. And all you need to do is look at historical charts. Why did the market turn then? Why did the market turn at that point in time? What was that? What did you see happening? Oh, well, I do see happening that home sales started going from down to up. So did building permits. So did mortgage defaults start going from more to less. What about housing affordability? Yeah, housing affordability at the bottom was houses were 50% affordable. What were they at the top? 15. Oh, so maybe affordability has something to do with that too. I mean, and sometimes you don't even know why. Other than, supply and demand that can be measured. Housing affordability can be measured. And sometimes you just have to look at things and go, what booms tend to lead to busts. Everybody knows that. And what's happened in the past, the best way to determine what's likely to happen in the future is to study the past. It is. So you got to look at history. And I know most people don't have the time or the interest or, to do that. And they think that everything just goes up forever. And that's why the average American doesn't do well. They don't do well. I mean, even I know people who've been in real estate for 40 years, and they're still struggling. I know one guy that I saw a mortgage broker that had a little sign on his desk. He said, "God, just please give me one more real estate boom, and I promise I won't screw it up this time." But you think everybody does well. Not everybody does well at all. It's really hard to succeed in life. And you have to take advantage of every advantage you can. And that's why it's really, really difficult to succeed in life. But is it worth it? Yeah, I think it is worth it. I mean, all of a sudden, you don't have to be the richest guy in the world. All of a sudden, you get to be, 60, 65, 70 years old, whatever the case may be, and you're comfortable financially. If you work because you want to work. But are you required to work to make ends meet? No, you're not. Another thing you guys got to do by the time you're 65, you got to pay off your house. That gives you all the freedom in the world. Pay it off. And what's interesting about today's times is that, and I get this information from mortgage brokers. They know the story. They tell me, you can't believe how many people over 65 years refinance their house for a variety of reasons to get cash out of it or get a lower rate or something like that and have a 30-year mortgage on their house. In other words, they're going to be in debt forever. And eventually you just come to the point where, you want to accumulate enough assets and you own your home, and you still have a business, a good business maybe, and that and Social Security, you have a comfortable lifestyle. You don't have to worry about things. Are you worried about food prices? Really worried? No. Do you like what's happening? No, I do not. But at least it's not a financial burden on me, or it has to be with you. So over the course of time, guys, you just have to do the highly probable things over a long period of time, and 50 years or whatever from the time you start working to the time you end. And if you do that, you're going to be in good shape.
Are more people continuing to leave California than moving in?
Absolutely. I mean, who's leaving? People that have money. Why? Because they think that the government's going to try to take it, or the left-wing rhetoric has gotten so insane that it's driving them crazy. I mean, but big money is leaving, and who's coming in? I don't know who's coming in. Are they counting these illegal aliens that are coming in? I mean, but you see the exodus. There is an exodus of big money out of California. They don't want to be a part of this. They want to be a part of more of capitalism than socialism. So it is leaving. But has it dramatically affected purchase prices? Not in the state as a whole. I mean, housing prices are more or less the same as they were, let's say 2 years ago. That's not the case in there's extreme examples. Are people leaving San Francisco? Duh. And housing prices are down 13% from their peak, their old peak. And so but some areas are worse than others. In San Diego, people are flooding into San Diego. San Diego, by the way, that and Orange County are the two most conservative coastal areas in California. Interestingly, like L.A. and San Francisco, they're off the chart liberal. And you go into the Central Valley that produces something like 40% of all the food for the United States, or some other ridiculously high number. Super conservative. Farmers are conservative. They're conservative people. And I know that for a fact, because half of my relatives were wheat farmers in eastern Washington. Boy, oh boy. Really, really, really conservative people. And the last time I went out there to visit where they lived in a town called Mansfield, Washington, eastern Washington, about 100 miles away from Spokane. And my dad and I went to the local graveyard to look at, where all our relatives were buried. And back that time, most of these people were born in the late 1900s, when I don't know what the average life of most Americans is, and this is leading up to my health and fitness tips, guys, that most Americans, let's say, were living to be like 60 years old back then. And I'm just making up that number. When we went to the graveyard, all my relatives that were wheat farmers, they were living in their 80s. 80 years old. What explains that? Farming is hard work, guys. I used to go out to my farms on a couple summer vacations just because I like being outdoors. That throwing bales of hay on a truck, or picking rock, or doing anything. It's hard work. And what that hard work translated into was lives that were considerably longer than most people were living at that time. And there was my proof for me. Yeah, I had grandparents, my dad's grandparents that were living into their mid-80s. And this is around the turn of the century. And unbelievable. And so that's one of the things that's convinced me over the course of time. You have to stay active. You have to lift weights. You have to keep your body strong. You have to keep your mind strong, and all that kind of thing. And the dividends as far as health and longevity will be off the chart.
Do you have any wisdom and or health and fitness tips to give us quickly?
I just gave you the biggest one there is right there.
There you are.
Living proof. And what you got to do, guys, you have to do this. That what I do is I go to the gym twice a week. I do anaerobic exercise where I work out hard 4 days a week where I'm actually sweating. And that will keep you healthy. That will keep you healthy. And you got to do strength training because that keeps your body, strong, and a strong body will help fight up disease, all kinds of disease. I'm ex-Air Force pilot, and when I go to the VA every year for a physical, my doctor there tells me, Mr. Campbell, if all my patients were as healthy as you, I'd be out of business. And there's certain things I've done over the course of my life. I come from a construction family. Is that hard work? You're damn right that's hard work. Frame a house. And doing the grunt work I did when I was a kid. Haul concrete around in a wheelbarrow, when you're pouring the slab. Those things are heavy. And you know who does that kind of stuff? People that are getting ready for a heavyweight fight. And it'll make you strong, but it will make you healthy. And the biggest secret of all I can tell you, guys, as you get older, is to take care of your legs. It's the fountain of youth. And why is it the fountain of youth? One thing, when you look at pro athletes, how they train, it's all lower body. It's all lower body. They're not doing bench presses and military presses. That's upper body. That makes you look strong. Lower body makes you invincible. And once you get older, the biggest reason you want to take care of your legs and have strong legs, it keeps your ass off the ground. And when you get older and you take a fall, that's usually the curtains for most people. It's usually curtains. And so I take care of my legs, and I'm out walking my 2 beagles in canyons and things, and there's no asphalt out there, no concrete, there's uneven surfaces that rocks sticking out of the thing. And do I trip around and stuff like that? Yes, I do. But I don't fall down. And that's all because of leg strength. Because once you get older and fall down and you break a hip I don't even know what the hell you do, typically that's the beginning of the end for you. So take care of your legs, everybody. And I know most people don't do that. And you go to the young guys at the gym. And gym's my favorite place because everybody there's for a common purpose. And there's no competition between us. We all push each other. Nobody talks politics. Nobody talks climate change. None of that kind of stuff. It's all just like, let's get as strong and as healthy as we can. But they're at the gym, all the younger guys, they're all doing bench presses. Bench pressing upper body, doing curls and things like that. You can tell the people that really know what's going on, they're taking care of their legs. They're doing squats. They're doing lunges. They're doing calf raises. They're doing kettlebell swings and that kind of things. That's what's going to save your ass, guys. That's what's going to do it. So take care of your legs.
Bob, where can people follow you, buy your book, Timing the Real Estate Market, and subscribe to your newsletter?
They can go to realestatetiming.com. realestatetiming.com. And with respect to health and fitness, which I'm focusing more and more on these days because it's new and exciting for me, that I publish a blog post about once a week, sometimes once every 2 weeks. And my last blog post, for those of you that are interested in health and fitness, and I believe everybody should be, my latest blog post was titled, Saying No to Aging, My Own Story. And I'm telling people exactly what I did. Exactly what I did. And my final words to you guys I want to emphasize health and fitness right now because it's foremost on my mind. I worked out, one of my gym homies is a retired medical doctor. He had a practice in Del Mar, California for over 40 years. And we became friends at the gym. He'd seen me down at the beach. He used to swim in the ocean every day, and he'd see me running down the beach in my bare feet in the soft sand. Soft sand. So we got to be friends at the gym. We both went to the same gym, and he said, Robert, I had a very successful medical practice in Del Mar. Most of my clients were older, and the majority were very wealthy. Do you know how many of those people would trade all of their money to be as healthy as you? And I didn't even answer. He looked at me and said, all of them. And those were words, guys, I will never, ever, ever forget. So it's something, once you have bad health, reversing that is very, very difficult. So don't let it get to the point of that. But I will always remember those words. And any time that I think, like, gee, I'm too tired to go to the gym, or I'm not going to do it this week or this month, baloney. You go. You go. Because all the money in the world, guys, I don't care how successful you are in real estate or any other endeavor, money can't buy good health. It cannot. So you got to do whatever you can, and your health is your own responsibility, and to a large degree, it's in your control.
Bob, where can people follow you, buy your book, Timing the Real Estate Market, and subscribe to your newsletter?
At realestatetiming.com.
Bob, thank you so much for being on This Week in Money.
You're welcome, Jim.
My guest has been Robert Campbell, publisher of the Campbell Real Estate Timing Letter. His website, realestatetiming.com. He was speaking to us from San Diego. Coming up, Wolf Richter, next on This Week in Money.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Welcome back to This Week in Money.
Thanks for having me back, Jim.
Wolf, are we finally able to get some deals when we shop for a new vehicle?
Yeah, so there are deals out there now, finally. The problem that many dealers are having is that they're completely overstocked, and especially with the Stellantis dealers, so the Jeep and Ram dealers, they're sitting on it's a nationwide average on over 150 days of supply, which is huge, which is more than double what dealers normally would like to be. 60 days is considered healthy, and 90 days is considered overstocked. So they're sitting on 150 days plus supply. Dodge is in that group. Then the Chrysler and Lincoln are a little bit below that. There's a whole bunch of Japanese brands that are just a little bit below that. Ford's at at about 100-day supply. So, and then there's some brands that are they're a lot lower, but that's a sign that manufacturers need to start cranking up their incentives to sell vehicles, to get them off the lots. And which is a good thing to see, actually, when you think back of how it was a couple of years ago when the industry was essentially out of cars and the lots were empty and dealers slapped on $20,000 addendum stickers to MSRP, and the whole thing was just a gigantic mess, and people bought cars that were way overpriced. And that came because of the semiconductor shortages, and it caused all kinds of supply chains to not function anymore. So this has been largely resolved, and so now automakers have been cranking out vehicles. And of course, during the pandemic, they shifted to the higher end models that they had. So they're selling fewer vehicles at a higher price, and that's not working anymore now for mass market sales. They need to start producing the lower end models that they have and the less decked out versions of it, and they need to come up with some huge, big, massive incentives. Now, auto dealers or auto manufacturers outside of Tesla and some of the startups, they don't really change the MSRP. What they're doing, and those MSRPs go up from year to year, but what they're doing is they're putting on a lot of incentives. So the MSRP stays the same, but the incentive brings the price down that the consumers have to pay. And so that's happening now. It's not happening enough yet. There's a lot of complaints that Ram, Jeep, and Dodge dealers are not getting the big enough incentives they need from the manufacturer to move the inventory. Other automakers have been a little bit more aggressive. This is just a good thing now for consumers to finally see this glut of vehicles on the lots that automakers are having to promote to sell and having to discount to sell. And so this is starting to be a relief from the crazy era there a couple of years ago.
What's the auto industry up to now?
Yeah, so they're struggling with that, so they're struggling with this glut they have in inventory, and they're trying to maintain their profit margins. So they're reluctant to really cut as much as they should. But they're starting to cut, and that's what we're seeing. We're seeing profit margins coming down. We're seeing incentives going up. Sales have been good, so that in terms of the prior 2 years, sales are up. They're still below where they were before the pandemic. So before the pandemic, we sold about 17.5 million new vehicles per year in the United States. Same as in the year 2000. So really, there really hasn't been much of a change. There's a big trough in the middle, but in terms of the number of vehicles sold, we're kind of stagnant for the past 2 decades. Where this year we're running at a pace of about 15.5 to 16 million vehicles, so that's still below pre-pandemic times, but it's the highest since the pandemic. So sales are coming up from the pandemic lows, and and the thing is, if the automakers really are trying to get rid of the inventory, they can come up with rate buy downs like 0% financing and 1.9% financing and those kinds of things, plus cash incentives to get that to happen. And we're already seeing some of that. We're already seeing some of those rate buy downs.
Are there some great deals out there on electric vehicles?
Yeah, it's all around. It's not just vehicles with internal combustion engines. Tesla has been on the forefront of cutting prices, so other EV makers have jumped in behind it. Tesla has also started offering special finance rates on its Model Y. There are other automakers that are trying to compete with Tesla. Ford's cut prices on its EVs. So it's a very competitive market out there. And there's new entrants all the time now. So new models coming by other automakers, by legacy automakers. So there's more competition on the market. There's more to choose from. It's a much more vibrant market than it was before. With it's just essentially Tesla running it now. There's dozens of models on the market. Some of them are now true mass market vehicles. Others are still in the early production run. So we're not seeing a lot of volume coming out from automakers just yet, and they're having all kinds of snags in their supply chains. And it's really hard to ramp up a completely new vehicle like that, where the entire supply chain is different from an ICE vehicle. So it caused Tesla a lot of problems over the years, and it's now causing legacy automakers a lot of problems. And then the U.S. government came in with incentives with these EV credits, and $7,500 per vehicle, per new vehicle. But they don't apply to all new EVs. They only apply to those with the non-Chinese content, and so it causes some bizarre things to happen, like the Tesla's Model 3. Most versions of it don't qualify for it, but the Model Y does, and because of the batteries that the Model 3 gets from China. So we got a pretty complex situation out there now with these EV incentives and applying to some vehicles but not other vehicles, and applying to leases but not to purchases, and those kind of things. So it's very confusing, and people have to do their homework, but they're starting to be, it's aggressively competitive now.
When buying new vehicles, what's the difference between a manufacturer discount and a dealer discount?
Yeah, so manufacturers give dealers special not only discounts but also incentives. So like volume incentives, where if they sell a certain number of units per month, they get an extra big pile of money. And they're giving per vehicle incentives. They're giving cash rebates to consumers. You know, there's all kinds of deals at different layers, and some of those rebates are in lieu of rate buy downs. So when you finance at a special rate of 1.9%, you don't get the cash rebate, and those kinds of things. So these are coming from the automakers. Then in addition to that, dealers can give up their profit margin, and so they can make deals on top of those. So when they sit on a lot of inventory and they want to get rid of it, they will price those vehicles to where the profit margin picks up the lower prices. And that's happening too, and it's happening all the time. And a lot of this, depending on where you buy, you negotiate this with the dealer. A lot of times dealers advertise that so you can see it online, how much dealer rebates or how much dealer discounts they're giving. So these are two layers of discounting that's on these vehicles now.
Here in Vancouver, Canada, we see Teslas everywhere. You're in San Francisco. Are you seeing Teslas everywhere?
Yeah, they're everywhere. They're in California overall. Tesla is the number 2 vendor behind Toyota, and moving in on it. So that's the Model Y is the most popular model in California, and Tesla's Model Y, and beating the Toyota models. The Model 3 is near the top. So these are true mass market vehicles now. On a global basis, the Model Y is the best-selling vehicle, and was the best-selling vehicle in 2023. So it's a true mass-market vehicle now. In the United States, it was number 2 behind the Ford F-150 pickup truck. And so they're, especially in California, I don't know what the market share is anymore, but it's true. 10 cars drive by, a bunch of them are going to be Teslas.
We've heard stories about Americans falling behind on their auto loans. Are U.S. consumers in trouble?
Well, consumers overall are doing really well. There is a subsegment of consumers that are now getting in trouble on their loans. And this is the subprime rated consumer group. So they're not really a big part of the car business. They're a small part. They don't buy new cars. They don't qualify to finance a new car. So they finance older used vehicles. And we have seen the delinquency rates of the subprime rated customers shoot up. And the Fitch tracks those, and they're over 5% now, the delinquency rates of subprime rated customers, and versus prime-rated customers, the delinquency rate is close to zero. And it's like at 0.3% or something. It's minuscule. And so that's where it's happening now. And that's always, subprime is always in trouble. That's why they're subprime. They're in over the head in debt. They took out too much debt. They have a history of not making their loan payments or not fulfilling the obligations. Subprime does not mean low income. It means bad credit. And there's a group of subprime rated consumers that are high income. They just borrow too much money and they fell behind on a bunch of stuff, and it goes very quickly into subprime. So if you're behind on a couple of things, pretty soon you're subprime. It doesn't matter if you make $250,000 a year. And so that's the part that we're now seeing getting in trouble. We have seen several specialized subprime auto dealers and lenders shut their doors because they ran into trouble. But it's a minuscule part of the auto business. It impacts only a small part of the used vehicle market, the older used vehicles. So these are 10 years roughly, maybe older vehicles. That's the sweet spot for subprime financing. And it doesn't really impact volume that much because it's such a small portion of the business. It's right now the default rates are above where they were before the pandemic for subprime, and it's concerning if you're in that business. Subprime is a specialized part of the auto business. It's normal. Regular dealers don't really engage in subprime financing. It's what the specialized dealers do, and we've seen some real bloodletting in that. The subprime auto loans are securitized into asset-backed securities and sold to investors and bond funds and so forth. And that money pipeline has gotten a little bit tighter. So because the losses have grown, so what we're also seeing is that customers that fall behind on the loan payment on their car will then catch up on the loan payment and fall behind on their credit cards. So they're kind of arbitraging. So they fall behind on one and catch up on the other, and then they change back and forth. And so we really haven't seen the actual losses jump that much. We've seen the delinquency come and go like that, but the losses are where actually the vehicle has to be repossessed and sold at a loss. That really hasn't happened that much yet. So we're noticing that the customers are still trying to make this work, and so they're juggling credit cards versus auto loans, and they're catching up in one and falling behind the other, and then they're reversing that. So that's kind of the status where we are.
Are auto loans a canary in the coal mine for the economy?
And so auto loans, like I just said, the prime auto loans are in pristine condition. They're superb credit quality right now. Their delinquency rates are minuscule, and that's kind of what we're seeing in the broader consumer economy. On the other hand, subprime is always in trouble, and subprime is in trouble now. Again, of course, they had the relief during the pandemic when they got all this free money, and subprime delinquency rates across the different loans plunged to historic lows. And that has ended. The free money has ended. There's none of this anymore. So we're back to subprime being a problem, and we've seen it in credit cards. So these are people on credit cards that are maxed out on their credit cards, and that's 18% of the credit card holders are maxed out. And not every American has a credit card, so it's really a smaller portion of that. Also, Americans that have a credit card, 18% are maxed out, and of that 18%, a portion of them is delinquent. So that's what we're seeing in the subprime sector. In the sector where a relatively small number of consumers are struggling, and they're always struggling, and we're seeing that get a little worse.
What do you expect the Bank of Canada and the Federal Reserve to do in terms of rate cuts?
Yeah, that's interesting. That's a good question. Obviously, everybody would like to know that. The Bank of Canada has been communicating that it's approaching a rate cut, and normally they they sort of moved together, the Bank of Canada and the Federal Reserve, and they don't want to get, the Bank of Canada doesn't want to get too far ahead or too far behind the Federal Reserve. The Federal Reserve indicated late last year that they were maybe aiming for 3 rate cuts this year. That logic is now off the table. We've had a resurgence in inflation. So those 3 rate cuts have been walked back. There's a lot of uncertainty about that now. There may not be any rate cuts this year. And so the Bank of Canada will treat very carefully here, because if there's too much of a disconnect, it shows up in the Canadian dollar. And so you'll have a decline of the Canadian dollar against the U.S. dollar, and that is something the Bank of Canada wants to be careful with. So it is possible that the Bank of Canada will do 1 rate cut and the Fed will do no rate cut this year, for example, and that's probably manageable as far as the Bank of Canada is concerned. There's discussion in the among the Federal Reserve governors about a rate hike. So going the other way, even though that chance is not very high, and there's a lot of hoops to jump through before the Fed will hike rates. But that's the discussion we're now in. We're looking at a different scenario here, and Canada has a different inflation scenario than we do, and so the Bank of Canada will have to deal with its own inflation, which is lower, and it hasn't had that resurgence that we've had. So I imagine that there may be a 1/4 point difference that the Bank of Canada will cut by a 1/4 point, and that the Federal Reserve will not cut, and we may see the Bank of Canada cut coming up this summer, and maybe the Fed will cut late this year, and maybe it won't cut at all. So I think the difference. I think that's as far as the Bank of Canada will go. They do the cut once, and if the Fed doesn't cut, the Bank of Canada will hold as well.
Are banks constricting credit?
Yeah. So we just got FDIC data on our banks. The FDIC is the bank regulator and deposit insurer, or one of the bank regulators and the deposit insurer here in the United States. And they do the quarterly data release on the banks. And banks are taking some pretty serious credit losses in commercial real estate now, and they have constricted lending in commercial real estate. So their financial conditions overall in the economy are very loose. So in terms of companies issuing bonds, of issuing leveraged loans, these are chunk-rated loans that are then sold to loan funds and to life insurance companies and to securitize and all these things that go into the public markets. They're pretty loosey-goosey. But in terms of bank lending of loans that bank hold on their own books, that has tightened in terms of commercial real estate. It's now very difficult for a commercial real estate developer to get new funding for a project. The rates have come up, and a lot of the models that they were using a couple of years ago when they were planning these projects don't work out with 7% interest rates. So they worked at 3.5%, but now they have 7%, and the rents won't be high enough to pay for the mortgage. And so there's a lot of projects now that aren't getting funded from banks because the math just doesn't work out. And so there's stalled projects, and everybody's just kind of waiting for rates to get cut. And if they don't get cut, it's going to be another issue. But commercial real estate has seen a significant tightening in bank lending. Other parts of lending haven't really. We have not really seen a lot of tightening in terms of consumer loans or mortgages or any of that. That's still as liquid as it was before.
Regardless of the interest rate, when banks decide to constrict credit, does the economy suffer?
Yeah, so let's look at the commercial real estate situation, for example. Now, when construction projects are started, they're going to get completed unless there's a huge crisis. So we really haven't seen the full results of this tightening in bank lending to the commercial real estate sector yet, because it impacts projects that haven't been started. But when a lot of these projects get put on hold, you will see construction work decline. And so the employment in construction, the spending by construction workers, the spending by companies on construction workers, all this will come down, and the secondary and tertiary effects. So this is an example where if you shut down lending to commercial real estate developers, you will have a broader impact on the economy and the employment sector and in everything that construction workers are spending money on, and you'll have and it sort of spreads through the economy. So you'll see that, and right now that's really all the place where lending is constricted, and it's not big enough. So commercial real estate and construction isn't really big enough. Commercial real estate there's a lot of construction going on, like residential, and single-family residential construction is doing pretty well. So it's not that part. Commercial construction of infrastructure, power plants, those kinds of things, they're going well too. It's just like the office sector and multifamily that are getting in trouble with bank lending standards getting tightened, and so you'll see if that starts to move forward, and if the constrictive lending starts to impact actual construction work, you'll see a somewhat noticeable impact in the overall economy.
Wolf, where can people follow you, and can you just tell us a little bit about Wolf Street?
Yeah, wolfstreet.com. That's my website. It's free. There's no paywall. It's business, finance, and money. That's all we do. We don't do politics. And we have a vibrant comment section, wolfstreet.com.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Robert Campbell, and Wolf Richter. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.